It was quite a week in the stock market last week, wasn't it? Did your broker, your broker, call you weeks in advance and ask you or suggest to you that you take precautions? Did you lose money? Did you maybe make money? Are you asking yourself today, is this just a pullback to be bought? Is this the big one? Do you subscribe to the philosophy that it's not possible to time the market? I just won't bother. The market always comes back and it'll be off to the races in just a few short weeks and months. Nothing to worry about, nothing to see here. Let me introduce myself and share a perspective to answer some of those questions. I am Bagger Don at StockMarketCaddy.com. It is Saturday, August 3rd at 11 a.m. First, I'm not a broker or a financial advisor. We don't make specific recommendations to specific people to buy or sell any security. We are not soliciting funds to manage, and we're not promoting any individual security at all. We offer a mentorship for those folks who want to learn how the game is played and so that they can play the game for themselves. And yes, it is a bit of a game. It's the money game. This is a chart of the TLT. What is the TLT? It's an exchange-traded fund of treasuries, 20-year plus treasuries. Now you may be asking, and I'll ask you, what is the difference between a bond and a stock? Do you know? How do bonds move and why? They're much, much bigger than stocks, and they're much, much smarter. Bonds move on interest rates. Do you know how? And do you know the relationship? If I was to say to you, bonds do go up, what are interest rates doing? If bonds go down, what are interest rates doing? Now we'll hold off any kind of notion that bonds move in the inverse of stocks. That's not always true. Sometimes it is, but not always. Here you can see for the last year or two, bonds have been falling. The TLT at one time was at 140. It went all the way down to below 80. Maybe your broker put you into bonds when it was up at 140. That wouldn't have been good. Why? Interest rates were rising. The Federal Reserve was increasing rates, and rates were rising. As rates rise, bonds go down. At that time, the rates were rising because the economy was cooking. Prices were going up. People were happy to pay the higher prices, whether it be for a couch, a car, a second home, a trip, or a McDonald's Happy Meal. And they kept paying, and they kept going into debt to buy stuff. Now, suddenly, last week, you can see on this chart that bonds have appeared to have bottomed. And last week, bonds broke out. They moved significantly higher very, very quickly. Why? What was happening with interest rates last week? They fell. They fell 200 basis points. A very, very big move. Now, you might be wondering, isn't that good? Thinking that mortgage rates went down, and they did go down. But the problem is, they went down not for good reasons, but for bad reasons. The reason why interest rates are going down is because the Fed has been successful raising rates to try to quell higher prices. We are in our view, a recession now, and we've been in recession, and we're going into a deeper recession. What is a recession? It's when people retrench. They say, no, I'm not going to spend $10,000 for a couch. I'm not going to spend $80 for a Happy Meal. I'm not going to spend $80,000 for a Chevy Impala, even though it has 6 cylinders. They say, no, I'm not going to do it. Or maybe they just say, I don't have the money. I'm completely leveraged out. What happens? Prices begin to fall. And the inflation starts to come down. Now you may be thinking that's really good. However, put yourself into the CEO hat or role of a company. If you can't sell the couch, we'll focus on the couch. If you can't sell the couch for $10,000, you mark it down. And you mark it down and you mark it down until somebody buys the couch. And that's what's happened. In fact, in the last 6 months, nobody was buying couches. A furniture company by the name of Conn, C-O-N-N, the largest furniture manufacturer in the country. They own Badcock, they own a whole bunch, or they did, Babcock, a whole bunch of others. They filed for bankruptcy. You may not have heard that. Now you may be thinking, oh, that's a couch, a stodgy business. I'm in AI, I'm in computers. It doesn't matter. No, it does matter. Think about it. People need some place to park their ass. And when they can't afford to buy a couch, it's telling you something. It's telling me something. Now, when that company goes bankrupt, the prices of the couches are going to dramatically fall. Yes, if you have money and you're interested in buying a couch, maybe over the next few months that might be a good idea. But they're also going to lay off a whole bunch of people. And those people are not going to be able to afford to buy the Happy Meal for $80. That's going to put more pressure on prices of stuff. So what does that do to stocks? Their revenues go down. Their earnings go down. So the really, really smart people, the really, really moneyed people who have billions and billions of dollars like Mark Cuban and Warren Buffett, what do they do in advance? They move billions and billions of dollars out of the stock market because they know they're not going to get a good return, a growth return on their portfolio. So they pour money into the bond market because they're not interested in getting a return on their money, as they themselves are pushing the interest rates down because they're all piling in. They're just interested in getting a return of their money. Because in 6 months, a year, 2 years, it may be 5 years, the recession will come to an end and they will have money to buy assets. The question will be, will you? Now, nobody knows, and the recession will be choppy. There will be feints. There will be significant stock rallies during the recession that will fool a lot of people, not us. When this occurs, everybody will be asking, when has it bottomed? I can only tell you historically that bull markets last about 6 years and recessions, bear markets, last about 18 months to 2 years. However, this bull market we've been in has started in 2009. It is some 15 years long in the tooth. So there's no telling. This recession could last for 5, 6, 7 years. So now is not the time, in our view, to be rushing out and buying a whole lot of growth. And in fact, in the months ahead, prices will come down. So if you're going to be in the market for a couch, you're probably going to pay less. If you're in the market for a car, you're probably going to pay less, and the interest payments will be less. If you're interested in buying a house, the prices are probably going to be less, and the interest payments are probably going to be less. If you are hawked up to your eyeballs in debt and you lose your job in the recession, God help you. I'm Baggert on at StockMarketCaddy.com. Time is the most valuable commodity of all. It can't be bought or sold. If you want to learn how to maneuver around these markets, short term or even long term, It's $100 a month. Annual memberships you can see on the website. Look at your portfolio from last week. How much did you lose? Did you hear from any of your stock pimps? It's one thing to lose money. It's another thing not to learn. Are you learning from them? Feel free to visit stockmarketcaddy.com. Feel free to give us a call, 813-758-8263. I'm Bagadon at stockmarketcaddy.com.